I remember the feeling of going from strategy to strategy and just thinking, why is nothing working? And that was until I came across Wyckoff. What we're going to do today is go for a complete comprehensive guide on how to trade Wyckoff for dummies. So whether you've been trading for 5 years or whether you've been trading for 5 minutes, by the end of today's video, you're going to be able to trade Wyckoff with so much more ease. So with no further ado, let's get right to the video. Before we can start trading this, we need to understand the origins of this strategy. Now, there's a lot of people online who try to claim, like ICT, who tries to claim he invented Wyckoff, he invented AMD accumulation. But listen, this is a strategy coming from someone who was trading at 15 years of age back in 1888. So, Mr. ICT, if you're watching this, unless you was born in 1888, you did not invent these concepts. So, what you got to understand is that Richard Wyckoff is one of the goats of this industry. Back in 1907, he opened his own trading firm, and in 1937, he actually hit stop loss, and rest in peace, he actually died. But during this time, he was actually trading on the trading floors, and what he discovered was that these trading floors are governed by algorithmic price, meaning institutions are not sitting there doing technical analysis and reading charts and drawing trend lines. They're running algos. And these algorithms are basically trying to facilitate orders at different prices. And through his studying of the tape, he created these concepts called the Wyckoff strategy. Now, this is one of the most tried and tested strategies there is, because for myself, I've been trading this now as a full-time trader for the last 5 years. And I haven't deviated from this strategy because I didn't need to. I like this strategies because it uses more logic. You see, it's actually understanding how institutions are filling their orders over time, rather than just saying, oh, price is going to magically bounce off a trend line. It's giving us the why, it's giving us the when, it's giving us the where, and it's just completing all those questions for us. So with Wyckoff, essentially it's about understanding the bigger picture and what we call the composite operator is trying to do. The composite operator, it sounds fancy, it's basically just another word for the institutions, because what you got to realize is institutions are the only people that can move the market because they're trading so much volume, they're trading so much money. And when these guys come in and trade and actually enter a buy order or enter a sell order, it's literally going to move price because they're trading with so much money. It's like if you own 10% of all Bitcoins in the world and you decided to sell, what's going to happen? The market is literally going to drop off. So what Wyckoff is actually understanding is how these institutions facilitate their orders and how you can identify the footprints of these institutions filling their orders so that you can basically piggyback alongside these bigger players and catch the bigger moves when the market is actually going to make these moves. So let's break it down into simple terms that anyone can understand. Firstly, you've got to understand it is governed by the law of supply and demand. And traditionally how it's taught is that, when demand exceeds supply, prices are going to rise. When supply exceeds demand, prices are going to drop. It's like, for example, clothing brands. It's like if you look at Louis Vuitton, they're limited, they don't make a lot of clothes. That's why they charge such a high price and their clothes are very expensive. And the less clothes there are, the more expensive it is. Vice versa, so mass-produced clothes, they're obviously going to get cheaper and cheaper and cheaper because they're produced at such bulk. However, for me, supply and demand is a little bit differently. Now, for me, this is true, but for me, it means a little bit more than just that. Firstly, it's understanding that supply and demand represent buy and sell orders in the market. Anytime you hear supply, you're seeing sell orders actually being filled in the market. And anytime you hear demand, it's representing buy orders being filled in the market. And remember what we said earlier, larger players can't trade like us. So they must spend time filling their sell orders. They must spend time filling their buy orders. When these guys fill their orders, it takes time because for every buy order, a sell order must be matched. They can't come in and enter 10 sell orders if there's not 10 people to buy it from, right? There needs to be someone on the other side of the trade. So what will happen when these guys are filling their orders? Time's going to pass, opinions are going to form, and it's going to create what we call a schematic on the chart. Now, we're going to go over schematics a little bit later, but you can use these for a directional bias from a technical standpoint and what we call points of interest, which is basically areas to buy or sell from on the actual charts. Now, there's a second law when it comes to Wyckoff, and that's called cause and effect. Now, how it's traditionally taught is that every move in the market is going to have a cause, which leads to an effect. Essentially meaning that nothing is going to be random, and that when you have an uptrend, that's going to be created by an accumulation. The accumulation is going to be the cause, and the effect of that accumulation is going to be the uptrend. Vice versa, a distribution, which is going to initiate a downtrend, is going to be the cause, and the effect is ultimately the downtrend. But for me, again, it means a little bit more than that. Because if every effect has a cause, nothing can be random. You see, we know that 1 pip on Euro USD costs over $1 billion to move. So if we're seeing the market in a range where it's moving 10 pips, 10 pips, 10 pips, 10 pips, 20 pips, 30 pips, 50 pips, and it's doing that for a few hours or days, money's being spent in that area for a reason. So why would any move be random? So when you truly understand Wyckoff, every move you see on the chart can actually be interpreted and explained if you actually know what you're looking for. This also allows us to grade different schematics in terms of probability, because if your schematic hasn't done anything and it doesn't have an effect, that's going to be less probable than a schematic that has. If you've seen because if you've seen an accumulation go and break a distribution to the left, well, that accumulation is going to be way more probable than a random accumulation that just hasn't done anything yet. This is what allows us to grade the actual power and the probability of that schematic itself. Now, this is where we move on to the third law, which is effort and result. How traditionally it's taught is that the more effort, aka volume, is put into a price move, this should be consistent with the result, aka the price movement. So if we're seeing a lot of volume but little price movement, something's not right there. But for me, again, it means something a little bit different. Firstly, it means duration, because we know that every pip costs money. So if you're seeing a lot of effort go into a creation of a schematic, where it's in a range maybe for a week or a month or a year, bro, that breakout is going to be absolutely huge. It's not going to be a little 10 diddly pip move. That's going to move for hundreds and thousands of pips, because that market has been intentionally accumulated or distributed by a bigger player with a larger agenda and a larger purpose. So the bigger a schematic, the duration, the longer the duration of this schematic is being formed, the more important or more powerful, and ultimately the more probable that schematic is actually playing out. Furthermore, who is actually behind that schematic? Just because you've seen what we call an accumulation, and again, we're going to get into this a little bit later if you still don't know what an accumulation is or a distribution, don't worry, we're going to get into all of that. But essentially, it's discerning who's behind that. Just because you've seen an accumulation on the chart doesn't mean it's driven by buyers and the market must rally now. Because if you haven't validated that schematic is driven by buyers, what can happen is that accumulation can actually be driven by sellers, and now ultimately that accumulation is just not going to work, and you're sitting there scratching your head like, why is this accumulation not working? Why am I hitting stop loss? So essentially, it's just truly being able to discern when buy orders are actually being filled in the market and when sell orders are actually being filled in the market versus fake moves that occur. Because what you'll see is something called that composite operator. It will create what we call liquidity. Now, liquidity doesn't mean it's going for John's 0.01 lot size on his micro account. No, institutions couldn't care less about retail traders. But when we say generate liquidity, it means that it's spending time filling orders at certain areas. And it's down to us as analysts to determine, are buy orders truly being filled here? Or are they just taking profit? Or in fact, even filling sell orders with a different agenda? These are the principles that I teach inside the Master of Coin Mentorship completely exclusively. So if you want to learn more about that and have the opportunity to work with me on a one-to-one basis, be part of our live trading calls, all you can do is go to the description, apply for the Master of Coin Mentorship, and if you qualify, we'll be in touch. One of the biggest keys before we actually get into these schematics is that they are not chart patterns. So many people come in with this mindset of, oh, I've seen the accumulation, it looks exactly like the schematic, so it must work. Bro, how dumb do you have to be? This is not, like, every moment in the market is completely unique. Just because something looks like an accumulation doesn't mean it is, right? Sugar looks like salt, doesn't mean it's the same thing, right? A lady boy can look like a lady, doesn't mean it's a lady. So you have to realize that so you have to do your validations to actually make sure this is an accumulation. You have to do your validations to make sure this actually is a distribution, and you're not trying to trade chart patterns. Chart pattern trading will not work. So you really think institutions who are sitting there trading billions of dollars have got photos of schematics and photos of flags on a wall? And no, bro, don't be stupid, bro. What we're doing here is we're studying market behavior, not an opinion. We're studying actual market facts. And that's the difference between Wyckoff and all the other strategies. Every other strategy you look at is an opinion of the market. It's someone's interpretation. Whereas Wyckoff, this is going straight to the information. This is actually studying how institutions fill their orders on a large enough time frame, rather than, oh, price bounced off this magical line, so let me buy it. It's studying market facts. So, with no further ado, let's get into the actual schematics and how Wyckoff actually manifests. We firstly have to understand the traffic light system, and this is essentially understanding that each schematic will have 3 main events. there's a few more phases and events, but in a nutshell, to help train your eye, firstly, stop the market, it will wait at a level, and then it will actually continue in its next direction. So what we have here is our Wyckoff accumulation schematic. Now, with this, an easy way to start training your eyes for this if you're new is looking for what we call a drop, base, and a rally, where you see the market drop down, spend some time going sideways, and then rally into the upside. Now, getting a little bit more advanced, there's a difference between just identifying a schematic and actually validating a schematic, because just because you see something that looks like an accumulation doesn't mean it's an accumulation, because it could be driven by buyers or sellers. If sellers are driving this accumulation, it's never going to work out. It's not going to create a reversal. If it's being driven by buyers, and that's what they generally tend to be driven by, an accumulation, where the market is coming down, consolidating, and during that consolidation, the institutions are entering their buy orders. And when they enter those buy orders, it creates this accumulation schematic, which has different phases and events. However, if buyers are not actually driving this market, it won't reverse and it won't just start going up. If the sellers are driving it, it will just kind of go up a little bit and then just smash to the floor and not work out. So essentially what we're seeing, if this accumulation is valid and it is a correct accumulation, it's when buy orders are entering the market for a reversal or a profit taking for a redistribution if it ultimately fails. Now again, these can manifest as different types. There's a bunch of different types of accumulations because again, it's not a chart pattern, it's a study of market behavior. So you want to go on the charts and spend time training your eyes to seeing these schematics over time. But what you need to understand today is that each phase, where you have phase A, you have phase B, you have phase C, you have phase D, this has a phase, this has an intention. So what you see in phase A is essentially the first interaction of demand, because you're in a downtrend, right? The market's dropping and dropping and dropping. So in phase A, it's that first set of buy orders being filled. And if buy orders are actually being filled, you should start to see a seller's climax that will lead to an automatic reaction, essentially just stopping the prior trend. Now, if the trend is successfully stopped, the market will now start to consolidate. And if the market now starts to consolidate, this is where we enter phase B. The whole purpose of phase B is allowing time to pass so opinions can form. People can get in, people can get out. Liquidity can start generating so these institutions can now start to fill their orders. Because remember, they can't come in and just drop $1 billion and the market just rallies. They have to spend time doing that. Because what if there's not $1 billion orders for them to actually buy at price 100? They might have to go to price 99, 98, 97, 96, 95, 94. And it's going to spend time to fill those orders at each of those levels. And only once they fill their orders can the market now start to move. So what happens in phase B is this is generally the bulk of the consolidation, where nothing's really happening. You're looking at the market like, oh, is it going to go up? Is it going to go down? You're not really sure what to do. But this is where the secrets lie. Are you actually seeing buy orders being filled? Because if you're seeing the market consolidate and fill in large buy candles, that is showing you signs that buyer orders are being filled in phase B. Now, from there, what you want to see is phase C, where phase C is your spring. It's essentially your manipulation, your shakeout to not only take out any weak hands, so anyone who got in early, but it's for them to fill that last buy order at the cheapest price possible. Now, typically this is where they save like the bulk of their orders, because why would you buy something at, £100 when you can buy it down at, maybe £80 or £70 at a discount? So usually in the spring, it's doing a few things. It's shaking out the weak hands and allowing them to get the cheapest possible buy order. Because if that spring is successful and they fill that last buy order there, what will now happen is phase D will occur where you have a sign of strength and the market begins to break out. And it's only until this breakout can you actually confirm that your accumulation is actually completed. I don't know if phase A is completed until phase B is completed. I don't know if phase B is completed until phase C is completed. I don't know if phase C is completed until phase D is completed. I don't know if phase D is completed until phase E is completed. And phase E is now just the market entering an uptrend, essentially. But of course, we must be able to validate each phase using the validation criteria. Because if we don't, how do you even know if this accumulation is valid? And this is where it comes down to getting the right information, which of course is all included in the Master of Coin mentorship. Next, if the market successfully accumulates and it now starts to rally, what you can see is a phase of reaccumulations. And essentially these reaccumulations will look like the market rally, kind of create a base and then rally again. And during this rally-based rally, it's essentially more buy orders actually entering the market. So this allows us to take continuation plays because sometimes the market may not return and retrace back down to our points of interest. So being able to identify these reaccumulations allows us to actually take trades a little bit higher in the range and catch some very high probability continuation plays. Now, what will normally happen during these reaccumulations? It will typically entice short sellers, and you'll know not to sell this because you're in an uptrend. Why would you try to sell an uptrend? You know what I mean? It doesn't make any sense. You're not going to jump in front of a train. You're just going to get on the train as it's going in a direction. So with these reaccumulations, normally what they'll do is they'll actually start to create a distribution at the start. During that BC to AR, phase A, it will create a lower time frame distribution, which we're going to get into in a minute. It might create some fake breaks of structure to show people, yes, we're going to now retrace. Yes, we're starting to sell off. And everyone starts selling off. And then what will happen is you get that spring, right? Because you see that little break, everyone's like, no, we're bearish, we're bearish, we're bearish. And during that spring is where everyone's seeing the market actually sell off and drop. So everyone's like, sell, sell, sell. And then what happens is shortly after that spring, you get what we call a jump across the creek. And normally in that spring, you'll see the market create a lower time frame accumulation. And during that lower time frame accumulation, it will break a new high. And once it breaks those new highs, that's what confirms the reaccumulation. So you can use a 3-prong test. And I'll do a whole video about this in the future, going in a lot more in depth because it's a lot to break down today. But essentially, look for a lower time frame distro. Don't sell the distro because you're in a bullish market. Let it manipulate to the downside. And after that manipulation to the downside, let it break to the upside. But this must be validated using, of course, each of the phase analysis. Now, moving on to the sell side, we have our distributions. Now, essentially a distribution, look, it's just the opposite of an accumulation. You really can just flip your chart upside down. But this is where sell orders are being filled, where you're seeing the market rally, base, and then drop. And I actually have a little typo here, but you always see the market rally up, base, and then drop off. So go to the charts and look at those areas where the market rallies up, pauses, and then drops. And look for the market manipulating highs, followed by breaks to the downside. That's how you spot these distributions. And obviously for an accumulation, it's going to be manipulation of lows, followed by break to the upside. It's literally just the opposite of each other. Now again, these can be driven by buyers, but most of the time they'll be driven by sellers. And this is where sell orders are actually being entered into the market. Remember, a seller's distribution will create a reversal where the market will go up, it will rally, create its distribution, drop, and just melt and melt and melt and melt. But one that is ultimately driven by the buyers, it won't. It'll fake everyone out and then create what we call a reaccumulation, like we mentioned earlier. Now, of course, these can manifest as multiple different types. This isn't a chart pattern. This is a study of market behavior. So it may look very different on the chart, and good, that's the point, because you're studying the tape and you're becoming an analyst, right? Trading is an art. It's not some, robotic thing where it's the same thing every day. It's an art form when you have to become better at studying the tape, just like Richard Wyckoff. Now, from there, if the market actually starts to sell off, what we can now see is what we call redistributions. Now, redistribution is where the market is essentially dropping, pausing, and then dropping again. And during this drop, base drop, you'll see it manipulate the highs, followed by breaking to the downside. The whole purpose of this is to further add sell orders to the market. And these are high probable continuation plays that we can get in instead of reversals, obviously like a distribution or an accumulation. Now, what these can do is entice buyers because we can use that 3-prong test where you may see on the left, it actually looks like an accumulation a little bit. And what happens is people get in on that test in B, they start buying, they see the UTAD and they're like, yeah, we're getting strength, let's keep buying it and buying it, before ultimately we get the sign of weakness to shake everyone out. But of course, you can't just pattern trade this and say, oh my God, it's dropped, base dropped, and manipulated highs, so I'm going to sell it. The key lies in the validation beyond that 3-prong test, which I'm going to do a video about in the future. If you want to see more about redistributions and reaccumulations, go down to the comments, let me know, and I'll create some more videos on this 3-prong test in a lot more detail. Now, ultimately, how do we actually trade this and how do we actually make money? Well, let's go onto the charts and take a look. So when you're on the charts, you're basically going to start seeing these Wyckoff price cycles, where if you're in a bullish market, you'll see the market create accumulations, reaccumulations, reaccumulations, and ultimately when the sellers want to come in, you'll see it create distributions followed by redistributions and redistributions, and it's literally going to look like on screen. So let's go to a blank chart and let's identify these different schematics. So firstly here we can see the market does what? It creates that rally, base and drop. So we can see our distribution actually start to occur. So what I like to do is put this little box on and label it a distribution. Here you can see you obviously got your buyer's climax, to your automatic reaction, to your secondary test, to your sign of weakness, creates your trading range. Obviously got your up thrust, obviously got your UTAD, then your sign of weakness. Now again, this isn't a pattern. That's why it doesn't look the exact same. But the more time you spend training your eyes, the more time you spend validating these, the better you get and the easier it will become to identify these schematics. Now, we know we've had a distribution. So after a distribution, what are we going to see? We'll see the market start to create these redistributions over here. So if we go to the chart now, what can we see? We can see the market starting to redistribute. We can see the market starting to redistribute. Then what do we see the market do next? We see the market start to actually accumulate. Then following the market cycle, what we see? We've seen the market create more reaccumulations. And obviously now we know that we're in a bullish market cycle. What are we seeing? Again, more reaccumulations of price, looking to continue this thing back to the upside and keep sending it higher and higher and higher. Now, of course, to increase the probabilities of this is where you add things like fundamental analysis to make sure you have a narrative behind your trades. Like, oh, I'm seeing a reaccumulation, but what reason do you have for the market to accumulate? Is there a fundamental reason for investors to actually want to buy this asset you're looking at? If not, then what the fuck are you doing? I'm sorry, but you're here to gamble. So you need to build that narrative and build a bigger picture to understand what's going on and why is that actually happening. So once we plotted up our schematics, the next thing we basically do is essentially wait for the market to return and mitigate one of these schematics. So what will happen sometimes, right, is the market will, let's say, create that redistribution and just drop. What I want to do is basically allow the market to retest that area, take an entry here before sending it lower. And obviously, if it doesn't retest, then I'm not really gonna trade it. Specifically, what's happening here is a process called mitigation. It's not an exact retest. And when I say mitigation, I basically mean that these institutions, like, again, why would you want to sell here when you can sell up here or sell up here? So what they'll do is they'll come in, they'll buy the market up before selling it lower. Now, when they do that, they're obviously entering buys down here, dropping the market lower. But when the market's down here, those buy orders are going to be in a loss, because obviously if you buy the market here and it's sitting below your entry, you're going to be in a loss. So what they'll now do is bring the market back up to retest or mitigate this area, and that's where our sell opportunities lie for the market to now reverse and continue to the downside. So obviously what we can do, we can come in, we can fib these up, and then we can look to take those entries off those 50 or 80 zones, which obviously we spoke about in depth in a lot more videos. And you can see the market comes down right to the 80%, mitigates, and obviously then goes and creates that new low for us. Now, of course, you can use this to get much bigger risk rewards on 1 to 6s, 1 to 7s. For me, look, I'm not getting out of bed unless it's a 1 to 10 risk reward. But of course, this is where now having a completed trading plan comes in. And having your different pieces of complements, and obviously having your entry criteria, your exit criteria for your trade management and your take profits, and basically knowing where you're targeting, and of course, building that narrative. Like when I'm trading, I'm not just coming to the charts and saying, oh my God, it's a redistro, sell, and just being blind like that. There's a lot more that really goes into this. As you start to trade, you'll notice certain areas and why certain schematics lose, why certain schematics win, why the market goes to certain areas. And through time, through collecting that data, you'll be able to build your plan around that. Or you can just be the smart person and just copy someone else's trading plan who's already doing it professionally like I did. Now, of course, if you want my blueprint, I did create a free training on that. You can go down to the description and obviously watch that blueprint. But essentially, this is how the market actually moves. It just creates these schematics over and over again. It doesn't matter what time frame you're on, right? You can be on an hourly time frame, zoom all the way out, clear the drawings. What are we seeing? The market creating reaccumulations. You know, we can drop down to a 5-second chart. What are we seeing the market do? Creating distributions. Creating redistributions. We can go all the way up to the weekly. It's the same thing across any time frame. The key is being able to train your eye to do these over time. And that's all it is, remember. Like, this is a skill set at the end of the day. And the more time you put in, the better you're going to get as an analyst. Because before you become a trader, you must become a proficient analyst first. And it literally just requires time. And remember, what does time mean? Time, T-I-M-E, things I must experience. The reason you're not a profitable trader and the reason why you're not at my level yet is because you haven't experienced the things that I have in my journey. And the only difference between me and you is time. I've had more time in the markets. I've had more time to spend training my eye and experiencing these markets. That's how I've become a full-time trader, is experience. So what you need to do is go get some experience. Go on the charts. Spend time identifying these schematics, but make sure you are getting the right schematics. Go and find someone who's a professional trader, trade in Wyckoff, and send them your photos. Ask them to make sure that these are valid schematics, because how do you know it's a valid schematic if you're not a profitable trader? You see, what I did is I had a mentor, and my mentor, I sent him screenshots. This is what I'm looking at. This is what I'm doing. Is this right? Most of the time they was wrong because I wasn't profitable. And then once I got that feedback from that professional, that's what allowed me to refine my strategy and obviously become a full-time trader for the last 5 years. So look, if you did like this video and you do want some more videos like this, obviously don't forget to subscribe. Look, we're on 7.2 thousand subscribers right now. My goal is to get to 10,000 subscribers in the next. Yeah, we're going to do it soon. I don't know when, I don't care when it happens, but look, when it happens, it happens. We're going to do some giveaways. We're going to do some in-person events, and it's going to be lit. So don't forget to comment, like, and subscribe. Stay for the journey, and I'm going to see you a lot at the top from the top, because man, that bottom is way too crowded. Sheesh.